and welcome to Live Market Analysis, an overview of key markets for Thursday, May 25th. Today, Jody Samuels, I will start by talking about the fundamentals that are driving this market. And then I'm going to turn it over to Juan, my colleague Juan Maldonado, who will show you the wave counts on our four asset classes that we're going to be covering today: stocks, the dollar, oil, and gold. First, please read the disclaimer to yourselves, and thank you. Today, we're going to be covering the following. We're going to talk about what's driving the market. It's really important to get a good handle on what the market participants are looking at on any given day, week, or month, because what you will find is that these market drivers will tend to influence the markets for some time if we get it right, if we see what drivers to focus on. We're also going to be looking at oil, the S&P, euro, and gold in the context of what happens next. So with the wave counts, that's Juan's role here. And then we're going to give you an opportunity to join the Elliott Wave desk. We're going to give you a very special offer, so please wait until the end. And as always, if you have any questions, please contact us at support@fxtradersedge.com. Intermarket analysis is key to understanding market correlations and what is driving the market. So when we have this session, we really do like to look at oil, stocks, the dollar, and gold, and see if we can pick up on some correlations. And what is a correlation? A correlation means that if you look at one market, it projects or predicts another market if those two markets are highly correlated. So that's our job, to see which markets are correlated, and then we can look at the two markets that are correlated and look at both and see, maybe we can get some clues if one is moving and the other isn't moving yet, etc. So at any point in time, there are different drivers, and we have talked about these drivers of Trumponomics and Fed rate hikes. After the election in November, those were the predominant drivers. And now we're adding in QE and ZIRP, zero interest rates, out of Japan and the Eurozone. And then, of course, we have some political drama in the U.S. So we are going to take a look at the post-election markets for stocks, bonds, dollar, and gold versus today. We're going to talk a little bit about BOJ and ECB monetary policy and how that is influencing things, and talk about the FOMC minutes from yesterday, and discuss risk on, risk off. Where are we for stocks, the dollar, gold, and oil? So when we last met in April, these were the four markets that we looked at: the S&P in the upper left, the oil in the upper right, euro in the lower left, and gold in the lower right. Now I've updated all of these charts for today, and what you will see is a different picture. So back then, a little bit more than a month ago, the S&P was in a correction. Oil was moving higher, the euro was trading down, and for the last 2 weeks of this chart, and gold was trading sideways. So now let's scroll down, and we see that the S&P, where you see the blue vertical line, that was the end of what was captured on the previous slide. So since that day in April, a month and a half ago, the S&P has moved higher. Oil, that's Brent crude oil. Brent crude oil moved up, came all the way down, and then started to head up again. And then the euro did an about face. The euro showed signs of strength and has continued to show signs of strength. And if you look at the little red down marker in the euro on the left, that was election day. The euro has practically retraced all of the losses. So what was going on back then to cause the dollar to be bought? It was all Trump economics, and the Fed, the market's perception that the Fed would raise interest rates and would be more hawkish than dovish. So the market attempted to buy the dollar, and then the market completely reversed over really since January, and we're using the euro as a proxy for the dollar. And gold has traded more or less sideways, but the last trading week has traded higher. So let's talk a little bit about stocks first. In the S&P 500, the top 5 firms are Apple, Facebook, Amazon, Google, and Microsoft, accounting for about 28% of the return of the index and 12% of the market cap. So in this environment, the breadth of the market is getting narrow, with 5 companies responsible for moving the S&P higher. What else is driving the stock market? Well, the central banks are also steering this market higher. And what's interesting now, and what's different from before, at least the market is talking about this, is that both the BOJ and the ECB policies have fueled their stock markets and fueled global stock markets with zero interest rate policies called ZIRP and monetization of government debt called QE. So, for example, with the basic money supply increasing in Japan, that provides more cash for investors to sell the yen and buy foreign currencies to buy foreign asset classes like foreign stock markets. And that includes the US dollar. It includes selling the yen and buying US stocks. So when this is going on, it's called a risk-on environment. And with easy money, we call it easy money in Japan, and easy money that the ECB is promoting, all this easy money provides cash for investors to invest in global stock markets. And on the yen side, this is called the yen carry trade. So we will shortly show you some of the currency crosses after I explain the scenario. We'll just pick it up again by looking at some of the charts. The combined Bank of Japan and ECB liquidity injections have really overpowered the Fed's plan to tighten rates in the U.S. So think of a teeter-totter. On the one hand, you have the BOJ and ECB adding liquidity, and on the other seat of the teeter-totter, you have the Fed planning to tighten rates and in a tightening phase in the market. But the BOJ and the ECB have won out because the global stock markets have continued to rally, and especially these internet and e-commerce companies. So this fuels a risk-on environment. Once the BOJ and the ECB decide to pull the plug on their inflationary policies of QE and ZIRP, that's when the risk-off card will come into play, but not until then. So what seems like a stock market bubble could go on for some time until these central banks change course. And of course, Draghi has confirmed that he is in no rush to raise interest rates or wind down QE. And as he has made that clear, the DAX 30 index has been an excellent European performer, as well as other European stocks. Also in this backdrop, I'm just giving you some of the background, with Emmanuel Macron defeating Le Pen in France's election, this also fueled money into Europe, and the Euro Stocks Index benefited massively. So in this risk-on environment, the end result, the euro and related currency crosses, so the euro currency crosses have also benefited. And that's where we see the euro. I'm showing you that the euro has benefited. So the euro in the lower left-hand corner has benefited substantially from the few things that we just talked about. The S&P in the upper left-hand corner is higher from back in April when we last had the webinar. And Brent, crude, and gold have more or less traded in a range. They haven't made new highs or new lows, whereas the euro has moved up to the pre-election highs. So we have U.S. politics also influencing the mix, and we have central bank activity, and we have European central bank activity as well, and we have fiscal policy in the U.S. Moving on to oil and gold, oil has been moving up and higher with the as and oil feeds into inflation, with the exception of today, which I'll just talk about. But oil feeds into inflation, and higher oil prices and higher inflation are positive to gold. So for gold. Now, if oil continues to move higher, that will also be positive for gold. However, today, some oil news came out, and oil sunk to its one-week low as OPEC's 9-month output cut extension disappointed the markets. And an extension was widely expected, but traders had started to speculate that the cartel would make deeper cuts to output or even keep the agreement in place for another year. And so this seems like a classic example of buy on rumor, sell on fact. So that was oil news today. So the question is, on the U.S. side, will the administration be able to deliver on reducing tax rates this year and increase economic growth? And will the political heat slow down on Capitol Hill to get these things done? And even if the tax reform plan isn't done soon, the stock market has shown resilience to every piece of news with some corrections and some pretty hard corrections as well. So let's just move on in the presentation and look at yields. This was the yield from April, and if we look to the far left, we see the yield on election day, and then in anticipation of Fed rate hikes, yields moved higher, and now yields have come all the way back down from the high of above 2.6% to 2.25%. So what is that saying? What is the market saying? The market is saying, gee, we're not so sure that. Well, let's talk about what let's talk about yesterday's less than hawkish FOMC minutes. The odds are that the Fed will hike Fed funds on June 14th, but on the Fed front, in light of yesterday's less than hawkish FOMC minutes, the market was disappointed, I should say. The market is convinced that the Fed will hike 2 times this year rather than 3 times, and that has caused a slight bias to a more dovish stance, and hence yields are lower. Okay, so in anticipation of this. So the market is reading into this as being less hawkish. On the currency front, the dollar first saw selling across the board until the market reversed with the euro selling off and the dollar yen moving up, so the dollar moving up towards 112. But initially, the dollar sold off on the less than hawkish FOMC minutes. So the bias is it has been for a weaker dollar against the euro. That's our proxy for the dollar, given the Fed, less hawkishness, and also what's going on with the ECB and the Bank of Japan central banks that we spoke about earlier. These are 4 stock markets, the S&P, the Dow, the NASDAQ, and the German DAX from our last meeting in April. And now I'm going to update them, and you'll see that all of these markets have moved higher. And the most visible move higher is with the NASDAQ and the German DAX. So both the NASDAQ and the German DAX made new highs. The S&P made new highs as well, but not dramatically. It's not a very steep incline. And that blue vertical line is basically where the rate was when we had our last market analysis review. And the Dow hasn't made a new high. So we double topped, but we didn't make a new high. In fact, well, I'm going to leave it to Juan to talk about the S&P. He's going to thoroughly analyze the S&P for you. So we talked about, in the U.S., will the administration deliver? We know about the election promises, tax reform, infrastructure spending, but we have to add political drama into the mix. That is definitely causing some market moves. We talked about the FOMC, hawkish versus dovish, and BOJ and ECB liquidity injections, how much longer, and that has caused a stronger euro and also stronger stocks, funding, putting investors flush with cash to enable them to sell their local currency and buy global stocks. So risk on environment, and that brings up the yen crosses. So let's look at the dollar yen. This is the weekly chart, and when we last met a month and a half ago, we were talking about a correction in the dollar yen that could take us down to perhaps the 50% level, and the 50% level it would also be somewhat of an equality target where the first swing leg equals the second swing leg, the distance. And this is what actually happened. The dollar yen actually did hit the 50% mark, the 50% mark being 108.82, and the low was slightly lower than that. And then the dollar yen quickly moved up to the 114 level, and now it has retraced 50% of the last minor swing move up. So usually when we have a risk on environment and the market is selling the yen, it's the dollar yen that moves up, or it's the dollar yen that moves up. So we have a weaker yen. But we can also see what goes on with the crosses. So let's look at the dollar yen versus the S&P and see if we have correlation between the dollar yen and the S&P, like we spoke about last class. And sure enough, we do. I mean, the dollar yen has started to move with the S&P. So that that's what's going on in this market environment. Now, it's not exactly one-for-one correlated. So we see that the S&P made a new high and the dollar yen didn't in this last moved up, but the direction is there. So you just have to look at the direction. And also, it could be that the S&P is more correlated with some of the yen pairs than with the dollar yen itself. And here are some of the yen pairs. So in the top left, let me just see something. In the top left, we have the euro yen. Sorry, no, we don't have the euro yen. the top left is the dollar yen, then the euro yen, then the Swiss yen. Well, have a look. Case in point, the euro yen and the Swiss yen have moved up. The euro yen has made new highs. These are the daily charts. And the Swiss yen is moving up to approach previous highs. But the euro yen has made new highs, and that makes sense in light of everything that we spoke about today. Down below we have the commodity crosses, the Canada yen on the left, followed by the Aussie yen, and followed by the New Zealand yen. All three of the commodity crosses have moved up in the last several weeks, 2 to 3 weeks, without making any significant new highs, of course, but certainly taking all of these crosses off, off the bottoms. So prior to, well, back in April when we had our last seminar, we were bottoming, and all of these crosses had moved down a long way. So it was more risk off in terms of the yen pairs. And now we are in more of a risk on environment. So the market selling the yen and buying other currencies to fund their stock purchases or whatever asset classes, stock and bond purchases or whatever other asset classes they're buying. So that's it for me. I'm going to turn it over to Juan now, and then I'm going to do something different. Before I turn it over to Juan, let me just show you what our special is, and I guess I'll show you at the end as well. Our special is the ElliottWaveDesk.com/expo, so please have a look at that. And what we're preparing to offer you is to join our Elliott Wave Desk and receive a free course with 4 modules plus 1 month of the Elliott Wave Desk with daily analysis videos that Juan does every single day on 13 markets. So I'm showing you this now so that when you hear Juan present, you can ask yourself, gee, wouldn't this be great to have Juan by my side every single day for a month and watch this analysis in video every single day? How great would that be to help with my trading direction, with my trading calls? That's what you need to ask yourselves. So I'm going to turn it over to Juan now, and you be the judge of that if you would like to have your own Elliott Wave strategist by your side.
Thank you, Jody. That was fantastic. Hello, traders. We are going to start with the wave count on the Euro USD. Always is important to start from a higher time frame, like the weekly chart, because on the weekly chart we are going to understand the big picture, and then we're going to be able to find the direction of the market inside and have a better idea about how to trade the market. This is the weekly chart. We are in a big consolidation that started 2 years ago on 2015 and has been consolidating, just bouncing between these 2 lines of the triangle. This is an Elliott Wave triangle. It's a continuation pattern, and currently we are inside that triangle. The price is doing the last leg of the triangle, and we have some room to the upside. The euro has been climbing pretty strong the last weeks, especially last week was really powerful, and it's showing a lot of momentum inside. So in order to find a reversal, in order to find the end of our leg E blue on the triangle, we will need to have a really strong confirmation on lower time frames. In the meanwhile, we can follow the move up, and the potential of the move up is around the 114 area because we have this distance, but knowing that at any moment, and we will be able to find that moment, it can reverse and start the new leg down. So the main thing we can find on the weekly chart is that the euro is in a bullish trend that is inside of a corrective wave, and that once the corrective wave is complete, we're going to see move down again to the lower zone of the 104 area. But in order to know the when, because now we know how it's going to happen, but we need to find when it's going to happen. We need to find the reversal. We will need to go to lower time frames and read the inside candles to have the better sense of the market movement. On the daily chart, the price is pretty powerful to the upside, but if we look to the left, it's just a retrace of the previous move. So it will be a good idea to grab a the Fibo tool, and just measure from the previous high, where the C wave ended, all the way down where the D wave ended, measuring the whole leg, and we will get some levels. The price currently is between the 61.8 and the 78.6. The 78.6, it's at the 113.43. That could be a nice level now that we are above the 61.8%. So on the daily chart, we keep seeing the euro pretty bullish. We don't have here any signal to think that the market is trying to reverse. Here, the last candles, the last red candle, we can see here this last red candle didn't close below the low of the previous green candle. So it's not a reversal, it's just a consolidation that is likely to continue. So we said that the price is likely to continue, so then we can go to a lower time frame like the 4-hour chart to understand what's going on the euro at this top. The price did a leg up during this last sequence, having this as a 1, this as a 2, this is the wave 3, this is the wave 4 that clearly got inside the previous wave 1. So this is an ending diagonal wave, and we need just another piece of this puzzle to complete the sequence. This wave 5 can extend and can go to that 114 area. We have to be ready for that, but knowing that we are in the diagonal wave. So that means that when we are going to visit the next time frame, like the hourly chart, we're going to find that each of these legs is going to contain a 3-wave sequence because it's an ending diagonal wave. Let's see the hourly chart. On the hourly chart, we're going to be able to find those 3 waves for each of the legs and also to plan the trade. Here we are, this is the hourly chart. The price completed the wave 4 orange. It didn't invalidate the wave count because it didn't fall below the 111.61 where the previous wave 2 ended, and then just started to climb. So there is the first leg up, wave A. Here is the B, and we are looking for another leg up to target the previous high, 112.69 area. 112.69, the previous high is the conservative target, and once the price gets to that level, we will read again the candles and see if it wants to extend more 113, 114 area, or if it is losing momentum, is trying to double top. We will read that information at the moment. For now, we can focus on this great move from the current price, 112.09 area to the 112.70 area. The B wave green visit the 61.8%, the golden ratio of the previous wave A. Precisely there, it reacted and it started to be sideways. The market reversal on this time frame will be confirmed by a 1, 2, 3 pattern. So the breakout of the previous high will be the confirmation. If you want to go more aggressive, you can use a faster trend line inside to actually already break out the trend line, and it's starting to move higher. So that could be a nice level to start making some tests, to start learning how we can capture the end of a corrective wave and start following the move up. That would be the plan on the euro. We have some nice distance to cover to the upside. Very well. Now let's continue with the S&P. The S&P, let's start from the daily chart. We are bullish on the S&P. We believe this is just a consolidation in order to continue with the trend, and has been a little bit choppy, especially during March and April, but seems that finally is starting to grow, is starting the continuation. The consolidation took a while. Here we have our wave 3 black, here we have our wave 4 black, and now we're in the wave 5 black. The wave 5 is going to contain a 5-wave sequence inside, and our target is around the 2470 area. The wave 1 red, and we are going to check that on lower time frames, it's over, and then the wave 2 will be active soon. So currently it's better to wait for the retrace for 2 before taking any decision. The price is a little bit expensive to try to buy it at this level, because we know that soon the wave 2 is going to start, so it's better to wait and get a better price than just trying to trade at a very expensive level. But the lower time frame is going to help us understand the internal sequence. Here we are on the 4-hour chart. We have a nice impulse for this wave 1. Today the price was having a little bit of difficult or a little bit of trouble trying to cross the resistance of the 2415 area. Is losing momentum a little bit, so let's be ready for the wave 2. The wave 2 is projected to have a 3-wave sequence, a zigzag ABC inside. Once we see the ABC, the next step is to have a trend line around the zigzag, and just with the breakout we can start looking those confirmations. At that moment the target will be again the previous high, and the next level inside this impulse will be the 100% for the wave 3 2448. If the wave 1 already ended, we don't have a reversal yet to confirm, but let's suppose that that's the top of the market of the wave 1. The wave 2 is likely to retrace 61.8% of the previous leg. That will be the 2373 area. And that will be the plan for the S&P, waiting for a retrace to get a better price, then a reversal to follow the market to the upside. And the next instrument will be gold. Gold has been growing. It started on May the 9th, and these days it is still active, the move up. From a daily chart perspective, we are getting ready for a fantastic setup. Is a classical pattern that is called the head and shoulders formation. This is a great example where we have the left shoulder, the head, the second shoulder, and we are at the top, close to the top of the second shoulder. But just with the pieces of this pattern that we already have, we can build the neckline. The neckline of the head and shoulders pattern is going to be the validation. Once we have the breakout of that neckline, the target will be at least the previous low 1130 area. But the idea to study the prices inside the lower time frames is to plan a trade before the breakout of the neckline, to catch that trade from the beginning of this C wave down, because we're expecting a C wave down, to find and validate the end of the B wave. So that will be our mission on lower time frames. Let's go, especially on the hourly chart. We have this fantastic consolidation that we have to be ready in case that it starts showing the triangle pattern, symmetrical triangle pattern. Using Elliott wave, we will need to wait for another leg in order to complete the 5-wave sequence required inside the triangle pattern. We have 1, 2, 3, 4, here will be 4 and 5. So this will be the wave A of the triangle, B, C, D, and E. If that happens, if this pattern is going to be the one of the continuation, we're going to move our way forward to the right, and right there will be a fantastic opportunity to start finding the wave 5. So what this means is that on lower time frames, like the hourly chart, is necessary to have a new high, just to show some divergence, to complete the Elliott wave cycle inside. And once we have the completion of the Elliott wave cycle inside, we're going to start finding the end of the second shoulder that we were seeing on the daily chart to find the short trade and get the best price possible for this trade. And let's take a look at oil. Oil has been one of our favorite instruments to follow this week. From the daily chart perspective, it has been trading inside of a channel. When we can have a channel around the price, it means that we are in a corrective wave. So these days, we are looking to validate the end of the wave 4, and actually we have the validation when the price closed below the trend line today. But also, I will show you what is going to happen next, and of course how we found that top of the market. So on the 4-hour chart, here we are, beautiful reversal after the 5-wave sequence for this C wave inside. The price couldn't continue moving higher, and then it collapsed, moving below the trend line and below everything. And on the hourly chart, we were seeing that the market was clearly divergent, was losing momentum, and that was our best hint to start looking for the reversal. Beautiful trade. Okay, so what's next? The next step on oil, and before that, just let's go back quickly to the 4-hour chart to explain the target. The minimum target is a 43.79. 43.79, so we have some nice distance to cover to the downside and to follow the market to the downside. Here on the hourly chart, we can have a plan using Elliott wave. The markets, when they are moving into the trend, when they are trending, they start with a 5-wave sequence, like a 1, 2, 3, 4, and 5. So first of all, for tomorrow, we'll be wise to watch for the wave 4, find the end, and follow the wave 5. Once we have the 5-wave sequence, here is the wave 3, here is the wave 1, here is the wave 2, we're going to get higher degree wave 1, and then we expect a wave 2, a 3-wave sequence for 2. So with this roadmap, it's going to be easier in order to navigate the markets, because we're going to be able to have a plan, and then we just add our strategy to mix this information with the strategy and validate the end of every cycle. After the end of the wave 2 black, we're going to start following the wave 3. So if you want to continue receiving this information daily with the wave counts, with our commentary, with the charts, and with all the details that we are providing in our service, now Jody is going to explain you how to join. Thank you very much for listening to this analysis, and I'll see you soon.
Thank you, Juan. Thank you, Juan. That was great, and I'm glad you showed the oil, which if you were subscribed to the service, you would have heard Juan talking about a market reversal in oil. So even though it was the news that actually caused oil to break down through the trend line, you can say you saw it here first in our Elliott Wave Desk service. So this is your opportunity to join the Elliott Wave Desk and receive a 4-module course for $17. And with that, you get 1 month of daily analysis. So a daily video every single day with daily analysis on 13 different markets. Do you want to have your Elliott Wave strategist by your side? Then go to elliottwavedesk.com/expo. And Elliott has 2 L's and 2 T's. 2 L's, 2 T's. elliottwavedesk.com/expo to join us in our Elliott Wave Desk service and have your Elliott Wave strategist by your side with one. So thank you so much, and we hope you got something out of this analysis webinar, which we hope to do monthly to share market views with you and help to navigate the markets together. Thank you.